So our next segment is our currency of the week. I think I mentioned it already a few times. Pound dollar. Here is US President Donald Trump with the big pusher for Brexit, Nigel Farage, former head of UKIP. So it's Brexit against Trump. Well, not only, we have other moving parts there as well. Let's begin with the pound. So March 9th is the date for triggering Article 50, and unless we hear other news. Parliament is unlikely to defy the will of the people. Of course, the Labour Party, which is in opposition, in theory, if they all unite, they maybe could have stopped Brexit, but well, some of them do support Brexit, and of course, they will not want to defy the will of the people, including in their own constituencies. So there will be a lively debate about what Brexit will have, but I don't think it'll stop the action. Okay? Parliament does want more control, more knowledge to be involved in the negotiations. Hard Brexit, which is currently the direction of the British government, is worrying for markets. They want a soft Brexit. That means more immigration, more access to the single market, less control of sovereignty. But the British government is going, I guess, with the will of the people to curb immigration and to have more control on everything. I believe that the actual triggering of Article 50, even though it's we all know it's going to happen, it could still hurt the pound, because that's when it really happens. That's when the clock for leaving the EU begins, the 2-year time, which is considered by all experts to be a short time for getting new trade deals. It could be problematic. So, and it could accelerate plans to investment plans out of the UK and things like that. Again, so far the UK economy is looking good. Tomorrow is Super Thursday. Let's talk a bit about that. So the Super Thursday, as aforementioned, is super because we have the rate decision and no changes expected. The minutes, which are attached, the meeting minutes to every rate decision, and the quarterly inflation report, which is what makes it super. Forecasts, it published in the quarterly inflation report, forecasts about inflation can be telling regarding the rate path. This means that if we see the Bank of England raise its inflation forecasts for 2017-2018, this means that they'll have to act to curb inflation. They could raise rates. And if inflation forecasts do not change or are even lowered, it could be quite bearish. It could hurt the pound, could show that the Bank of England could cut rates. In the previous big rate decisions in the UK, in August, following Brexit, they cut interest rates and also added QE. But since then, the pound, well, continued falling, inflation began rising, the UK economy didn't collapse, and in November they did not cut rates and even changed their stance from bearish, from a tendency to, from dovish tendency to cut interest rates to nothing, very stable, very neutral. So they're currently firmly on hold. This person, Mark Carney, his tone in the press conference and the quarterly inflation report will rock the pound, will make a difference for the British pound. Carney has this kind of dilemma. On one hand, the economy still looks good. So 0.6% growth rate, the unemployment rate is low, inflation is rising quickly, as we've seen, and the pound is just too weak. So if he raises rates, he could cool down the economy, lower inflation, lift the value of the pound, thus helping inflation. That's the reason for raising interest rates. But on the other hand, forecast for the future. Brexit is set to hit the economy. I think it's a matter of time. It could come sooner rather than later. And tightening might lift the pound, but also curb demand. So it might cool down inflation, leaving more money in the pockets of Brits, but also hurt lending, for example, hurt the wheels of the economy. So the Bank of England for tomorrow. I don't expect any decision. They'll wait for Article 50 to see the implications. They will wait for Trump's 100 days. Well, lots of things are going on in the White House, but maybe they'll want to wait a bit more. And they'll probably, as you can see here in the picture, sit on their hands, try not to do anything. But I believe that their tendency is more dovish than hawkish. I don't see them raising rates even if inflation picks up even more because of the high level of uncertainty. They wouldn't want to be blamed for hurting the economy. Okay, so that's the Bank of England, and let's continue our pound dollar special by talking about the Donald Trump here is signing yet another executive order in the White House. Basically, he's fulfilling his promises. So with all the criticism I have about him, you can't say he's not doing what he said. But markets, voters didn't expect him to do what he said literally. They thought he'll go in the general direction of what he said, but not word by word. The world is in shock, even though these are things he was talking about. More trade wars than fiscal stimulus is very worrying, okay? And the visit of the Mexican president has been canceled. He blamed China, Japan, and Germany for manipulating their currencies, favoring American companies, things like that. But no talk about fiscal stimulus. Uncertainty also about Obamacare. And, well, quite a mess, I would say. The Federal Reserve. Now, first of all, Janet Yellen here in the picture, she doesn't know what her future is going to look like. Trump talked about replacing her. That, of course, also is quite uncertain. Anyway, they're currently sitting tightly on their hands. I believe they'll act only on their big rate decisions. The next one is in March, and they don't expect a rate hike then either. Without saying his name, without saying the Donald, they want to see what Trump does, well, after a few weeks, not only after 10, 12 days. We learned that they lifted their forecasts based on Trump, only some of them, but this was enough to change the dot plot. The next forecasts are in March. Maybe we'll see them with a bit of disillusionment like other market participants from Trump's actions. So maybe they will lower their forecasts for rate hikes. And if we look at pound dollar, to conclude this segment, we talked about Brexit, the Bank of England, Trump, and the Fed. The pound is vulnerable to Brexit. The dollar is vulnerable to Trump. But the pound is probably the weaker link, as the greenback also attracts safe haven flows. So when we talk about safe haven flows, it's repatriation. It's going for something that will be more safe or cheap money that came out from one country to invest in riskier, higher yielding assets comes home. The number one safe haven currency is, of course, the yen. Okay, but second in line is the US dollar. Even if it's a far second place, the US dollar does have this advantage on the pound, which is not a safe haven. So in this ugly contest between the pound and the US dollar, I think the US dollar has a bit more strength. Will pound dollar lose 120? We touched that 2 weeks ago and bounced very beautifully from that level. I think it is possible. Anyway, let's look at the charts. My tendency is more to the downside on cable. So let's move to the pound dollar chart. Let's look at the big levels here. This is a daily chart. We reached on the night of Brexit, before we had the results, reached 150, dropped to range of 128 to 135, then further dropped to, 120 to 127 almost. The tendency I see as well, it's a bit mixed, but more bearish. Currently 125.80, 126, let's zoom in a bit, 126.75, 127.30, a small line, and 127.90 are the lines to watch. Further above, we have, of course, 129 and 130. To the downside, the big levels, 125.40, 124.15, 120, 120, and the round number of 120. Okay, below that, we're at the lowest levels since 1985. We did have that flash crash in early October. It's already 4 months since that flash crash. The move to the downside were not sustained. Let's see if the triggering of Article 50 makes these moves great again. Okay, so that's our segment about pound dollar, our special currency of the week.